Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we explain money how it should have been explained to us. So on this week's episode, we'll discuss what markets are signaling and how investors could protect themselves from potential volatility. Last week was a relatively calm week in the financial markets. The S&P 500 was up only a little over 1%. Please remember that S&P 500 is basically America's 500 largest companies. It's made up of about 11 different subsectors. Think healthcare, financials, think technology, energy, so on and so forth. Most investors are overexposed to the S&P 500 and they don't even know it. So when the indexes are flat, kind of like they have been year to date, this is where research, this is where bottom up analysis, right? This is where stock picking matters most. Year to date, as of last Friday, industrials and metals are the two leading sectors in the S&P 500. Both sectors are experiencing over 8% performance year to date. You got to think about the larger environment that we're in the Trump 2.0 era where reshoring is a real thing. Of course, industrials are set to benefit from that. Metals, on the other hand, has been rallying for a few years, long before Trump 2.0. This phenomenon started about a decade ago where central banks all around the world started allocating to gold and in many cases reducing their exposure to American securities. And then when the Russia and Ukraine conflict erupted in 2022, even more central banks started allocating to gold. You got to remember, gold has been used as currency for thousands of years. So gold has performed really, really well over the last few years, and there's no reason to believe that's going to slow down. Historically, investors have used gold and real assets in general as a way to hedge against inflation, political instability, against recessions and depressions. Another reason gold has performed well is because the Trump administration has publicly announced their intentions to either acquire or use military action to control Greenland, which other NATO members are not happy about. Therefore, we're watching central banks allocate to gold, which is creating upside pressure on gold. Another unintended consequences of political uncertainty is the potential spike in interest rates on bond yields. Given the political instability and rhetoric from the current administration, we're watching bond yields specifically on the longer end of the curve, which tend to influence credit card interest rates, mortgage interest rates. We're watching upside pressure given the political instability and the political rhetoric about acquiring or invading Greenland, as well as our $38 trillion debt and the fact that America has significant deficit, meaning we don't collect enough money in taxes to cover our spending. So think about this. If a person doesn't make enough money to cover their spending, what are lenders likely to do? Usually they charge more for credit because you are perceived as a high risk. It's the same thing when nations go to borrow money from the capital markets. If you are perceived as a higher risk, likely you're going to pay a higher interest rate. And granted, America has never defaulted on our debts, on our debt payments, but past performance is not indicative of future performance. So there's no telling what could happen in the future. And in a world where we don't collect enough money in taxes to cover our spending, we have $38 trillion in debt, but our economy is roughly $30 trillion. So that's an imbalance. And oh, by the way, there's a lot of uncertainty in policy and the political environment. The economy is very, very fragile. These things tend to provide upside pressure on long-term bond yields, which, like I said, is what drives mortgage rates, car loan rates, credit card rates, and all sorts of things. Yes, central banks control the short end of the curve, but the longer end of the curve, specifically the 10-year and beyond, is what's linked to those mortgage rates and linked to car loan interest rates and credit card rates. So these are just a few things we're watching out for in the economy. So now let's talk about policy and economics. So recently, the Trump administration floated the idea of prohibiting institutional investors from acquiring single family homes. The idea is to address affordability. Now, as a poor kid that grew up in the Bronx, I get it. And I get that housing is way too expensive. But I'm also an economics professor. And the rule of economics is supply and demand. And the basic law of supply and demand states in order to drive the prices down of any good or service, you need more of that good or service. You need competition to drive the prices down. And sometimes well intended policy actually does the exact opposite of what it was intended to do. I get that housing is a problem in America. Depending on what report you read, we have a shortage of residential units, between 3 to 6 million homes. But the only way to address the affordability problem is by addressing the 3 to 6 million shortage of homes that we have. We need more inventory to come online, not less. The issue is inventory. The issue isn't the demand. So to drive the prices down, we need more supply. Basic economics. Now, from a political perspective and the optics, it definitely looks like he's fighting affordability. The reality is the unintended consequences of that policy is less housing equals higher prices. This is going to destroy housing construction over the next few years. Explain to me, what incentive does institutional investors have to create supply? Think about the hurdles institutional or any person or any investors have to overcome just to bring more supply online. First of all, to build a house, incredibly expensive. Lumber, commodities, the materials that you need just to create a house are at all-time highs. Think about the inflation, the supply chain shift, and oh, by the way, tariffs. So just to build a house is incredibly expensive. Then you got to sprinkle in the local zoning laws and permits and the town halls and committees. And there's all sorts of environmental reports that need to take place long before a shovel ever hits the ground. Forget getting $1 in cash flow. Forget getting $1 in profitability. It is incredibly difficult for new supply to come online in the United States of America. And that is why housing is so expensive. So to address this problem, we need more housing, not less. We need to incentivize the development of single family homes, of multi-family homes, of manufactured homes, of mobile homes, of all these different things to address the actual problem, which is that we have a shortage of 3 to 6 million units in America. And until we address that problem, housing prices will forever be artificially high. The destruction of new supply coming online in America happened after 2008. You can see right in the graph above how construction after the great financial crisis started to deteriorate. And you can see in this graph how inflation after COVID skyrocketed. So explain to me, what incentive do builders have when you can see wages have continued to go up over the last 15 years. Wages are all-time high. The materials are all-time high. And of course, home prices are all-time high, making it incredibly difficult to address this problem. So, while I get that the intentions are well, I am in the camp that in order to drive the prices down, we need more inventory. Now let's talk about the breakdown. And in today's episode, we're going to talk about the 4 different asset classes. I'm in the camp that everybody's invested, whether you believe it or not. And if you're not invested, that just means you're sitting in cash. Cash historically has been what we call short-term paper. Anything that is quickly converted to cash in less than 9 months. Think checking, savings, CDs, money market accounts. These things are easily converted to cash. So cash is an asset class in and of itself. And if you are not invested in any of the other asset classes, that just tells me you are 100% invested into cash, which any professional investor will tell any other investor you probably never want to be 100% in any given asset class. So yes, cash is an asset class. And hopefully you are going above and beyond your checking and savings account because like I said, there are other forms of cash. Another asset class is what we call stocks or equity. When I think of equity, I think of a lemonade stand. Now, if that lemonade stand has one owner, then there's one shareholder for that lemonade stand. But if that lemonade stand suddenly grows and does billions of dollars in revenue, and there's millions of different owners that sit at the table, that tells me that there's millions of different stocks issued for that lemonade stand. And long term, whenever that lemonade stand is profitable, the owners at that table will enjoy the economics of that profitability. Bonds are basically an IOU. If that lemonade stand wants to borrow money to fund the growth of that lemonade stand, they could tap into the capital markets, aka the financial markets, raise money from bonds in the form of IOUs on a promissory note. Hey, I'm going to pay you back in such and such amount of time with interest, of course. But I'm going to use that money to fund the operations of my lemonade stand so that I can grow and compete with, the big leagues. And lastly, the other asset class that we should talk about are alternative investments. And typically, alternative investments are less liquid than some of the other asset classes, right? So you want to make sure that you plan accordingly. Now, when I think of alternative investments, I think of investing in real estate, I think of investing in private equity or hedge funds or even venture capital. But by and large, it's the same idea. Investors pool money together to go out and make investments and hopefully make a profit on those investments for their investors. But at the end of the day, alternative investments are less liquid than other asset classes, sometimes aren't directly correlated to what's happening in the other asset classes, especially the stock market. It could be a great diversifier, but you want to make sure it's aligned with your goals, your time horizon, and your overall risk tolerance. So, pooling it all together, what does that tell you? One, markets are fragile. You want to make sure you maintain diversification. You want to make sure you protect your downside. Let's make sure you have international exposure. Let's make sure you have exposure to small, middle, large companies. The most important thing about any investment strategy is that you are always in line with your goals, your time horizon, and your overall risk tolerance. You never want to take unnecessary bets. Good portfolios aren't built for headlines, they're built for the volatility. It's easy to make money when all markets are going up, but the superstars perform when there's a lot of volatility. So, folks, with that, I want to thank you again for taking the time out to listen to Invested in Us. We hope that you find this information helpful and informative, and hopefully it helps you make more well informed decisions. We ask that you follow us across all social media at Kevin Nunez NJK or at NJK Partners. Please subscribe to our weekly newsletter on Substack. And thank you again for watching Invested in Us, where we explain money how it should have been explained to us. Peace, y'all.